How much should I pay myself as the business owner? Should I just take enough to cover our living costs and see what profit is left at the end of the month or the year? Now, most business owners don't understand why it's critical to pay themselves a fair market salary or what a fair market salary even looks like. Tune into this week's episode where we dig into why a fair market salary is critical to your business success and how to calculate what your fair market salary should be.
It's really easy to pay yourself what's left over in your business.
They might say, hey man, yeah, look, I made $150,000 profit. And so that's not profit.
Are you taking enough? The hourly rate is way below minimum wage.
And so you'll think you're making a lot more money than you actually are.
You can't just run your business and make decisions about your strategy based on how much money's in the bank account.
If you are asking another employee in your business to work 65 hours a week, but you're only paying them for 40 hours a week, what would that other employee say?
When we do this properly, what we realize is that the business exists to serve you, and the business should be a vehicle for you to create a better life.
You might as well go and work for someone else and get paid that.
And so they have a tax bill that they also can't pay in terms of cash flow, plus they're going to get income tax on their personal income as well, which they probably haven't accounted for. So all of this is a
tax department nightmare. Alrighty, welcome to the podcast. Tony Fraser-Jones here, the host, with my good mate Phil Smith, co-host, man of the hour.
G'day, mate.
Yeah, what are we into, man?
Well, we're talking about fair market salaries, and I think the thing is it's really easy to pay yourself what's left over in your business. Basically just take the scraps of what comes out the bottom at the end of the month or year, and basically just take a salary that you need to live on and forget about it. So you calculate your bare expenses. This is what I need. You take that, and yeah, that's it really. And so you don't really know if your business can actually afford to pay you more than that, or whether or not there's anything left over, that should be more, or whether you're worth more, or any of the likes. You just kind of take what's there and lump it.
Yeah, and often it's got no sort of resemblance to what you should be paid or what you would be paid if you did a similar job for someone else, which is quite important. And so, often you don't even know what you should be paid or how often you should be paid. And like you said, you just take what's there, or when money's left over, you take it out to pay things, or even worse, you take money out when you need it, which may or may not relate to what the business is able to support right now as well. So I think in this pod today, we want to dig into why it's really important to understand what a fair market salary is and pay yourself that as well, and how to actually do it, how to go about it.
Yeah, 100%. So I'm sure you have a story to kick us off.
I do have a story. It's a little bit morbid, actually. I have a fascination with air crash investigation.
Oh, here we go.
I don't know what it is. I just find it fascinating, the way they unpack those crashes. But anyway, there's a very tragic crash that happened in 1978. And it happened in the Antarctica. And it's the Mount Erebus disaster. And there was a plane that was actually flew down to Antarctica to go on a sightseeing mission. Took people down, wined them, dined them. And this plane was flying around, and they thought all was good. But unfortunately, this plane flew straight into the side of Mount Erebus. And 270-odd people, I think, lost their lives in an instant, just snuffed out. Very sad, very tragic. But when they actually unpacked what went on here, there's some very interesting things happen. As you know, aircrafts have flight computers, which the flight is programmed, the route is programmed into the computer. And in this particular case, the computer was changed just before they flew, and the pilots didn't know. And the track was actually moved about 26 miles. Which meant instead of flying over the sea and over lowland, they were actually flying directly into the path of this volcano, Mount Erebus, which I think is like 13,000 to 14,000 feet high. It's quite high, quite hard to miss when it's in front of you. And so that wasn't good. And at the same time, it was actually quite clear, and so they couldn't understand why experienced pilots would actually fly into this mountain like this in front of them. What didn't they see it? Like, what was going on? Well, there's actually a phenomenon that happens in the snow conditions when the sun and the snow are all in the right position. You lose the horizon. Yeah, it all looks the same. It all looks like the sky pretty much. And this is what happened. It's an optical illusion. So not only were they on the wrong track, they couldn't actually see what was happening. They didn't understand where they were, and hence they actually flew straight into the mountain. Not awesome. But the moral of the story is, if you don't have a true picture of how things are, they can go wrong, and you can be completely on the wrong track, and that can have pretty catastrophic results, obviously, if you're flying an aircraft. But the same can happen with your business. You can actually fly into a mountain you didn't know was there because you didn't actually know what the situation was. And that's important when we're figuring out your pay, your salary. If we don't get that right, it can have some difficult consequences for running your business and actually knowing where you're at and getting the results that you want from your business as well.
Yeah, absolutely. And, taking that fair market salary at the right time and the right amount is crucial for you to know where you are, so to speak. So if you're not doing that or you don't know how to do that, then essentially your in-flight computer has been programmed wrong, and you could be headed straight for that mountain. So where do we start with this whole process?
I think the first thing is that to really run a business effectively and understand your position, and we're talking financial position here, and this is important because business is about, you need to be in business to make money. If you're not, that's probably another discussion. But if you don't have a fair market salary factored in for the work you do, then you're not really reflecting the true business costs, and therefore you can't tell how your business is performing. That's important, and so there's quite a lot to this. Like if, for example, you just take a drawing every week or every month, and you run a profit and loss, that's not going to show in your profit and loss, and so you'll think you're making a lot more money than you actually are. Or, for example, if you are, if you're a person who's still working out in the field, you're still doing a lot of the actual projects yourself, part of the tradespeople and the techs in your business, then when you look at your cost of goods and your gross profit, if you just take drawings, then that's not going to reflect in the costs in your P&L, and so you're going to think you're making more profit than you actually are, which is a bit of a problem. So really what, the big picture here is you want to make sure that the costs of your time and effort are reflected accurately in the accounts of your business, so you can make good decisions about the performance of your business, and that's the key thing. And the basic rule is, what would I have to pay someone else to do this work, and then that cost should actually be factored into the profit and loss, into the accounting of the business, because then we can see how the business is actually running. Yep. Otherwise, often it looks better than it is. Most of the time, actually, it looks better than it is.
Yeah, and unfortunately, like as we've said many times on this podcast, is you can't just run your business and make decisions about your strategy based on how much money's in the bank account. You got to manage off your financial statements, and so if your profit and loss is all over the place because you're taking money and not representing it properly, then unfortunately you can't use your financial statements either, which means that really it leaves you with gut feel, and that's not a good management tool.
It's not. And if you think about an example, is they might say, hey man, look, I made $150,000 profit. And we're like, hey, that's cool. And you look at it, and there's actually no line items in this profit and loss for their salary or their wages, for the actual work they did as an employee in the business. And so that's not profit, because profit is a different thing. Profit is like the reward you get for running a business. It's what's left over after all the expenses of the business are being paid. And if you don't treat yourself as an expense, then you've got a problem, because effectively, you're not accounting for your profit properly. And in this particular situation, maybe this person, $150,000 profit, actually they should have been paid $100,000 in salary or wages, and therefore the profit is only $50,000.
Or even worse, they took $150,000 worth of drawings, and now they have a tax bill to pay for that $150,000 worth of profit.
Yeah.
But unfortunately, they've already taken all of that as drawings, and so they have a tax bill that they also can't pay in terms of cash flow. Plus, they're going to get income tax on their personal income as well, which they probably haven't accounted for. So all of this is
it's starting to
joy.
Look like a tax department nightmare.
And furthermore, like, what if of that $150,000 worth of value that the person's added, if any of that was on the tools, let's say even half that time was on the tools, well, in that case, you got $75,000 worth of salary that should have been represented in the cost of goods as well. So not just on the P&L, but up above the gross profit line. And so that same client could be telling us, well, my GP's 40%. And it's like, oh, well, no, because if you included your time on the tools, that's actually going to increase your cost of goods, which is going to decrease your gross profit margin, and therefore they might have thought they're pricing their work well, but they're not. And so we're masking a lot of problems if we're not representing that properly.
Massive. And also one of the powerful things that we find when you work with a group of businesses, hundreds and hundreds of them, we know what the benchmarks of profitability are. If you're not factoring those costs in, it might look like you're making $150,000 profit. You're not. You're making $50,000, and that, if you're making $1 million revenue, that's not a big percentage. It's 5%.
Yeah.
And we know a business of $1 million should be able to do 15%, maybe slightly better, maybe a little bit less, but generally better in most situations. And so therefore this business is actually underperforming, even though it feels like to the owner, I made $150,000 and I'm cracking it, which is a big problem.
Yeah, absolutely. And I think the next thing is if you sort out your fair market salary, it really helps to prevent, what we call slavery of the owner. So I think it's really, really hard, if you're thinking about the value you add in the business, if you're just taking what's left at the end, then it's going to be really, really hard because you're running around, you're covering all the gaps, So sure, you have your core role and there's the core things that you do. Maybe you're pricing, maybe you're spending some time on the tools, you're running the boys, you're organizing jobs, sure. But you're also probably, chief bottle washer as well, and you're running around filling gaps everywhere. And so the hard thing is that often, even if you are taking some money or some salary or some drawing or whatever from your business, are you taking enough? And most often when we start working with people, the answer is no, because they're actually doing so much more than a normal 40-hour role per week. And they're doing so many little tasks and filling so many little gaps and masking so many, staff resourcing needs that actually when you work out their hourly rate, how much they're taking from the business, if you divided that by how many hours they're working, their hourly rate is way below minimum wage. And that's when we say you have owner slavery in place, and it creates a false economy, right?
It's massive. And if you flip it on its head, if you were asking another employee in your business to work 65 hours a week, but you're only paying them for 40 hours a week, which often happens when people take a salary or a set amount every week, then what would that other employee say? They'd be like, yeah, I don't think so, or they'd have their hand out asking for more money. And if you paid them, then your business would be reflecting the accurate cost. So this is really, really important. Like, it's a massive, almost philosophical shift that needs to happen, because papering over the cracks, basically, it feels like you're doing better, but you're not. I mean, I have to say I'm guilty of doing this. I used to own a restaurant, and had a franchisor who was pretty demanding and was always looking at the wage costs, and I would just pay myself a set salary. The trick was to do that, and I'd just work more hours, and it would make the wage costs look better. So they'd lay off me for a little while. It was just a very immature thing to do, and I didn't really get it at the time, but I figure it out now, and it just made life more difficult. It papers over the resourcing problems you have. You actually need more people, or you need more revenue to make the business work. So this is massively important.
Well, I think more than that, there's some stigma and mindset that goes with it. So, I think a lot of people think that because it's my business, I've got to pay my dues. This is this is part of it, right? I've got to do this. I've got to work these extra hours. This is what it means to be a business owner, is to bust my ass and work these late nights and weekends and put in this extra time and do the extra stuff that's required. Like, that's part of owning a business. And look, I'm not saying it's not. I mean, definitely you got to put in the hard yards if you want to get ahead. But if you're not representing that into your business expenses, then basically, sure, you're paying your dues, but you're technically not actually paying. And so as a result, everything looks like it's doing better. And like you say, you just create this false economy where you think you're doing well, you're actually not. And so you start making decisions or improvements that don't make sense, because honestly, you're not looking at the right thing.
Yeah, and the thing about this, Phil, is that if you're in business, really it's about creating leverage so you can get more work done rather than just your own 40 hours a week, and so that you can make a profit. So the point of business, unless you like pain, which you might create a high-paying job for yourself, but you want to create a business that creates profit, which is the reward for taking the risk that you've done in business. It's over and above the expenses you make, over and above all the costs that go in, of which your time is a major cost, and for you it should be the most important cost because it's your time. You can't get your time back, you can get your money back. So it's that mindset shift. We really want to put the pressure into the business so it's got accurate costs, so that we can cause it to perform, rather than taking a bit of an easier approach. Well, it's not easier in a way, but it's probably a little bit softer in a way of just sucking it up and we'll just fill in the gaps.
Well, you're being easier on your ego and on your mindset, but you're being harder on yourself, in terms of your time and effort and energy.
And your pocket and your lifestyle.
Absolutely. So, look, I think probably the next point for me is about business valuation. So I think a lot of people, when they get into business, it might not be your immediate goal, but at some point you'd love to get your business to a point where you could sell it, or at least it would be worth something, so that if you want to move on or retire or something, you don't just shut it down and that's the end. You'd sell it to somebody, and it would have value, and that will set you up. The hard part is that when you go to value a business, and especially value for sale, one of the first questions that's going to get asked is, well, what's the owner getting paid, and what are they doing in the business? And the reason for that is because people don't want to buy your crazy job. They want to buy, a proper business that's going to work for them. So what that means is they want to buy a business where the owner is not relied on, and where their costs are being fairly represented. Because the other thing that needs to come into this is that I need to know what type of profit this business is churning out, so I know what to expect when I buy it. And unfortunately, if you've misrepresented what you pay yourself or what you're worth to the business, then the profit number that you've put on that, which is going to completely affect the valuation, that's going to be wrong because you're not representing your efforts in the business. Plus, you've probably also misrepresented what it's going to take for a new owner or someone who's buying it, what it's going to take from them to actually keep the wheels moving. And so when this all gets uncovered, which it will in the valuation process, you'll notice the valuation you expected goes very, very low because it's A, not as profitable as you thought, and B, is completely reliant on you. So by representing this properly, what you do get is you get a fair look at whether or not this is actually worth very much, and therefore you know what to improve if you did want to get to a saleable point, in terms of profit-driving strategies, but also in terms of building that leverage you talked about, Tony, because, again, people want to buy businesses where the owner is not relied on, because then I can buy an asset, that gives me a return on investment rather than just buying myself, honestly, a low-paid crazy job, which is not a good buy.
The thing about businesses, and you may not want to sell your business, we're not saying you should sell your business, but a great business to sell, if it's well set up for sale, it's a great business to own.
Absolutely.
It's the same thing.
Yeah.
That potential outside investor coming in to buy your business, if they see that you've underpaid yourself and also that you're doing 1 3/4 jobs, they're like, well, I have to pay 1 3/4 people at market rate to do that, and they're going to just strip that out of the profit and change the valuation accordingly. If they do any due diligence, that's worth their salt.
Yeah, absolutely. So, what about the question of salary or wages versus drawings?
Yeah, good question. So that's a thorny issue, isn't it? People are like, well, should I pay myself wages or should I pay myself a salary or drawings, or how does that work? And I don't think it really matters too much as long as it accurately reflects what you should be paid. The main reason that you'll change between salary, wages, and drawings is often for tax reasons. So one of those models will be more tax efficient, and depending on which state you're in or county or country or whatever, it will vary. And you get some advice from those special people in your life, your tax accountant. Love them to bits. So that's the important question there. You might even run some expenses through your business that are slightly more personal in nature. I hope the tax office is not obviously legitimate. You know what I mean? You can do that as well.
We're not looking down on anybody here.
No, that's right. Never done it ourselves, obviously.
Sure.
The point is, when you actually do your accounts, you can take the accounts from your software, whatever that is, and you can actually even just run them through an Excel spreadsheet and what we call rinse them or make them clean.
Yeah.
Which means you'll account for what the salary should be. You'll include a line item for your salary, your wages each month, even if you've taken a drawing, because that won't appear in a profit and loss, but you'll factor it in to your profit and loss, and you'll take out those expenses that may or may not be quite strictly business related, so that every month you've got a clean view of your business, and that's the key thing. So you can take salary, wages, drawings, whatever you want. It doesn't matter to me. I think whatever's fine, just whatever works tax-wise, but then you actually create a set of management accounts every month which are clean, which do factor in your salary, wage, or drawing, and take out all the expenses that may or may not be strictly business-related. So then we know how the business is actually performing, and that's the thing we use to base our decisions on. Yeah,
absolutely. So just to summarize that, the numbers that are in your accounting package, QuickBooks Online or Xero, Mile, whatever it might be, you're using that to figure out your tax that you pay, and that's all cool. But if you download your profit and loss into an Excel spreadsheet, which is doable on any of those packages, then you can change things, add things, put things in or out, whatever it might be, and then you should manage your business off those accurate numbers. One way or another, it'll give you a much better place
even
to
your
start.
Accounting software, you can create different views of your P&L, which might be able to do that for you. But the key point is you want a clean view, so you know what's actually happening business-wise, which includes a fair salary for yourself, so we know how things are actually looking.
Yeah, absolutely. And I think another thing on that is you really want to make it a set amount each week or month. It should be regular. So, you don't want to be taking random big lump sums every now and then. You want to be taking a regular amount on, a regular basis, whether it's weekly, fortnightly, monthly, whatever. It doesn't matter. You just want to make sure that that's regular so that you can account for it properly.
Yeah, I think that's massive. And the reason for that is it's the philosophy of paying yourself first. You are the most important employee in your business, so make sure you get paid and get paid what you should be paid. So that's the first thing. Occasionally you might take an extraordinary drawing, and that's a whole different thing. But as a general rule, you take your wage or your salary, whatever period it is, monthly, weekly, fortnightly. And the thing about this is it also sets up the right incentives. It's telling your business, I'm getting paid first, you need to perform well so I can get paid first, and ideally so there's profit left over after that. It's a very important psychological shift. You're demanding of your business that it performs so that it can give you the money that you deserve for the work that you're putting in as an employee.
Yeah, absolutely. And that extraordinary drawing, I mean, that can actually be very regular because, again, you want a fair market salary that you're taking regularly. So that's the fair market rate for the role that you play in the business. Now, if you have a really, really, high-performing business and you do have great profit in there, then there is money there, which is, your reward for the extraordinary risk you take as a business owner.
That's your profit.
That's your profit, and you are welcome to take that whenever you like in the form of drawings. But that is definitely a drawing because that is you drawing actual profit, whereas you do need to represent your value to the business in your role on a regular basis, which is what we're talking about with fair market salary. So, when your business is performing well, you'll be doing both. That's really the
And a
idea.
good business should do that. If it's not making profit, extraordinary profit or super profit over what you're getting paid as an employee, you've got a problem with your business as well because
Exactly.
you might as well go and work for someone else and get paid that.
Well, that's really the point that we've been trying to promote in this episode is just making sure that we represent this fairly so that we can actually do it right. So next thing is promoting your work-life balance, and I think this is really, really important when we're looking at fair market salaries, because when you take a fair market salary, you're acknowledging the value of your time and effort in that business. And what that helps to do is it creates a separation of the business from you. So, you wear a few different hats in your business. There's the role that you play, which is the job that you have, and that's actually quite separate from your role as an owner. So as an owner, your purpose is to own this asset, which, gets more valuable and also gives you a return on the investment that you've made to the asset. Now, on the other hand, you have a role within the business, which is the job that you do. And you need to be able to see these quite separately. And one of the only ways that you actually get any work-life balance is to view the job that you have in the business as a job with a set amount of hours and a set value that it gets paid for a set number of activities. And outside of that, you should have your own personal time. And like we mentioned earlier, the hard thing is that as a business owner, often that owner hat creeps in too much into the role and you start doing extra stuff, spending extra time and not representing, the cost of that. Because, as we said, you just kind of take what's left at the end and not actually representing your market salary fairly. So with this, when we do this properly, what we realize is that the business exists to serve you and you don't exist to serve the business. The business should be a vehicle for you to create a better life and, help you to get a really, really great lifestyle. So when we represent our time fairly, what we're able to do is say, cool, I'm spending this much time in the business to do this stuff at this value. And when you can see that, because you're representing it in your accounts and your management documents, then it's really easy for you to realize when you're spending more time or burning yourself out because you don't see yourself being rewarded for it. And that, I think, helps with the mental shift of not throwing yourself into all the extra tasks, and instead what you do is you tend to resource those tasks properly. You hire other people, you expand your infrastructure. Because you only want to work the amount of time you've dedicated to on the right stuff for that value, and it just keeps everything fair.
Yeah, and this is critical. As you said, it separates the business from you. We've got to understand our business as it's something separate from us, and getting these incentives right. I mean, it stops that situation of owner slavery, which is what happens to so many people. You may be listening, you just do everything, you fill every gap, you're not getting paid for it. The business isn't actually showing that in its accounts, and you get burnt out. And so this is about actually putting the incentive into the business, putting the pressure on the business, that separate thing out there to perform, to serve you. And that's the key.
Yeah, 100%. So should we talk about industry benchmarks?
The thing about having accurate costing in your business is then we can actually benchmark your business against other businesses in the industry. And that's one of the cool things about, say what we do in a coaching program like ourselves. We know what the industry benchmarks are. And if your cost structures are set up correctly, then we can compare you to other businesses and see how you stack up. If you underrepresent your costs, it looks like you're doing better than you are, but you're not.
Yeah.
And when we see businesses who have, massively high profits, maybe they've got a profit margin of 32% net. Well, the first thing we're going to look at is, are the costs accurately reflected? And often a cost of $100,000 of owner's salary is not sitting in there. And that's a problem. And it's also, as you said earlier, really important for pricing. Now, you should price every job for profit. You should have some target margins that you're hitting for pricing and profit per hours that you want to hit. You'll go back and cost your jobs against those individually. Then every month you bring all the jobs in your business into a P&L and you look at the gross profit of your business for that month. And this is critical because your gross profit basically shows you, is your business profitable doing the actual work? Are you generating enough money off the jobs you do to pay for your overheads and some profit? Now, if you are one of those owners who are still working out in the field on the tools and you're not putting costs from your time accurately into that gross profit, then your monthly gross profit will be overstated, which often will hide the fact that you're not pricing high enough, your productivity is low, you're not well organized, you're not charging up all your team's hours out. And this puts the emphasis on you to get it right. And so your benchmarks will be all out of whack with the industry, and you'll think you're doing better than you are. And in fact, you might think your margin, as you said, is 40%, but maybe it's like 28%, which is actually not a good margin.
Yeah,
so
absolutely.
that's massively important. Just helps us to do better.
Yeah, and I think when we're looking at app benchmarks, you touched on it a little bit, which is as your business grows, the benchmark of what you should take as a fair salary, it grows with the business. So, there is no one answer where we say, oh, fair market salary is $100,000, because if your business is really small, might not be that, and if your business is really big, well, then that's way not enough. Like, it has to be fairly represented based on where your business is at,
and the role that you're performing.
Exactly, and the role that the business requires of you within that business. One quick thing is, if you are splitting some of your time into the field or on the tools, it's important that that's not just a percentage of the amount you take. So, for example, if I pay myself $200,000 as a fair market salary, and 50% of my time is spent in the field or on the tools, well then it's easy to say, well, that's $100K into my cost of goods. The problem is that if I'm not working a full 40-hour week on the tools or in the field, then honestly, like $100,000 for say 20 hours on the tools is overpaying. Like, you wouldn't pay a tradesman that. So how I would represent my time in the field is I would figure out what am I paying my best tradesman, and how many hours have I worked, and what would that equate to in terms of time on the tools value. And that's how much of my salary I would attribute into my cost of goods, which affects my gross profit. The remainder would go of my fair market salary would go into my overheads or my OPEX. And the fact is that might feel like it's a disproportionate amount in terms of hours, but in terms of value added to the business, it's not disproportional. That's actually better represented, because otherwise it looks like you're overpaying a tradesman, and that will actually make you feel that your GP is too low. So you've got to get this right.
You've got to get it right. And the key thing here is you reflect your salary or what you're paying yourself, your wages, however you take it, as what you would have to pay for someone else to do that role. So, for instance, if you are a tradesperson and your best tradespeople are paid $37 an hour or $40 an hour, that's what you would represent every hour you spend in the costs. If you're the estimator in your business, how much does it cost you to hire a qualified, proficient estimator? Well, you're paying, let's say, $100,000. Well, that's the salary that would go into your business. If you're the GM of the business and you've got a $10 million business that's really profitable and you're doing well, you might have to pay that person $250,000 or
maybe
more. And so that should be the fair market salary that's reflected into your business to give it an accurate costing picture so we can see what it's actually performing like relative to its peers.
And a good rule of thumb is, like, usually, let's say you're the estimator and most of your time as the owner is actually spent pricing work, then you'd figure out what an estimator would cost to replace you, and probably just add a little bit more, because you probably do a little bit more than that as well. So it would be just over what you would pay someone else to do your core role is usually a good rule of thumb.
Yeah. Hey, and like you said, this may not be perfect to the cent.
Yeah.
That's perfection is the enemy of progress, right? We want to get it pretty good.
Yeah, exactly.
So we've got an accurate reflection.
Yeah, and I think the reason we do it based on the role that you play is because we also don't want to overpay ourselves as a fair market salary either, because then that makes us look like the business is underperforming, which can affect you in a whole host of other ways. But really what we want to do is just get this about right, because that way it's actually going to be more beneficial for you and your management, but also you can still take profit on top of that. So you might say, but for a business my size, I'd want to be taking at least sort of $200,000 as the owner, or at least $300,000 as the owner. But if you're basically the estimator, then your fair market salary might be, say, $120,000, and you might still end up with $350,000 worth of income. It's just that the rest of it was in drawings, because that was coming from the profit as the owner. So
the accurate profit.
Exactly, but it's the accurate profit, and you've represented what you're doing. So how do we go about...
pretty simple. How do you figure out what you should be paid? Like, the logistics are relatively simple. It's basically a market research job, which is like, well, what are other people being paid? And so there's a bunch of ways you can do that. You can do some snouting around yourself, looking on the job websites and figuring out where roles seem to be sitting. You can get some benchmarking data and touch base with an HR or personnel consulting company who can help you with this pretty easy. And sometimes that's a good thing to do. It often doesn't cost a lot of money, and that'll give you some good benchmarks, some good ranges for where your job might sit. And just ask around what other people in the industry are doing. Maybe you're part of an association. A lot of associations will give you this data to help you figure it out. So that's basically what you do.
Yeah, I mean, recruitment companies actually release documents every year. It's part of what they have to do, which gives you a breakdown of a bunch of different types of roles in your country or your area, and roughly what they should be paid. So it gives you some really solid benchmarks. A good place to start. So I think we've covered a lot today. Should we land this plane?
Let's do it. So you are the most important person in your business. It's vital that you get paid a fair market salary. Now, plus, you must take a fair market salary so that you know how your business is performing financially as a business. Thanks heaps for listening. We'll catch you all again next time.
See you later.
Congratulations on being part of a select group of savvy business owners who are taking their businesses to the next level. And to help you on your journey, don't forget to check out our show notes for a copy of our free book, The Profitable Tradie, and other valuable resources. Thanks for being a part of this special group, and we'll see you in the next episode of the Profitable Tradie Podcast.